a realtor and talk show host all in one. Get tips, advice, and valuable lessons from the successful and rewarded Sotheby's Vice President, Jennifer Hammond. With more than 20 years of real estate experience, she'll make it look easy. Here is Jennifer Hammond.
Hello. It's Jennifer Hammond, and I'm here back with Linda DeMarler. We're talking about real estate and taxes. Again, you want to know these things. It's so important that you understand taxes. And again, so often you want to know it before you go into buying property. But even if you're in the house, we want to kind of make sure you know all the ins and outs. And so today's topic is all about that free lunch that's in the tax code for homeowners, specifically when you're going to sell. So, Linda, what is this free lunch?
Okay, the free lunch is a law that was passed many years ago that people hardly even know about. Most of the time people remember the old law where if you owned a house and then when you sold it, you had to buy another house within a certain period of time, and then the new house had to cost at least as much as you sold the old house for. Okay, forget that law, no longer exists.
It's gone.
Gone. Yes, the free lunch is absolutely super. It means that anybody, whether they're single, married, or whatever their situation is, can buy a home. Now, when I talk about a home, I mean it's the place where you live.
It's your principal residence.
Correct.
Yeah.
Yes, and that's usually defined as where you sleep at least 5 days a week. So you can have a second home or a third home, a cabin in the beach, or a cabin in the woods or something like that. But the home where your residence, this would be where you have your children go to school from there, your voter registration is there, your cars are registered there. So all you need to do to qualify for the free lunch is live in that house for 2 years and 1 day, okay? Now you've gotten over the hump, you've gotten over the threshold, you can sell that house and you can exclude from your income up to $250,000 if you're single, or $500,000 if you're married.
So let's go ahead and run through an example of that. So for easy math, just to make it simple, if you could buy a house for $100,000,
oh.
I know it's difficult to even think of that, but
good try.
Just try. So $100,000, maybe in Florida. I don't know.
Oh,
So
yes.
You bought a house for $100,000, and then you've owned it for 2 years and 1 day, and now you're a single person, and you go to sell it, and it has been amazing, and you are now selling it for $350,000. So you're literally profiting $250,000. There's no tax on that?
No tax whatsoever. That $250,000 goes right in your pocket. You can use it for any purpose you want. Usually people will want to buy another home, at least I would hope so. But if you need it to educate your children, or you want to take a trip around the world, or invest in a business, if you just want to sit it in an account and buy some nice mutual funds, whatever you want, that $250,000 is yours. And if this same example was a married couple, and let's use an example maybe a little closer to where we live around here. Let's say they were lucky enough to find a house for $400,000.
Right.
And they own it for how many? Do you remember? 2 years and 1 day. Then they can sell it after the 2 years and 1 day. And even though they paid $400,000, they could sell it for up to $900,000 and not pay any tax on that $500,000. That again goes in their pocket. Use it for anything you want.
And you want to compare that just for a second on if somebody had, for instance, they put that money in the stock market and they made $500,000 on their amazing stock. What would they be actually paying for tax?
Very good question. Well, the first threshold they would have gotten over was the fact that they held it for more than a year and a day, because that makes it long term.
Good.
But now all of the gain will be fully taxable at whatever their capital gain rate is. Now, capital gain rate starts at 15%, but when you have a large capital gain, and I talk about this before, $200,000 if you're single, $250,000 if you're married, then you automatically go up to the 20% bracket. And many times when you have a large capital gain, not only do you pay the capital gain tax, but you might be subjected to what's called the alternative minimum tax. You know what accountants call it? We call it the alternative misery tax.
For being successful.
That's right. So that rate starts at 26% and goes up to 28%. So the tax rate is one of those four, 15, 20, 26, 28. Now, if you also have this large gain, you're also quite more apt to be subjected to the health care tax, which is an additional 3.8%. So it could be 20 plus 3.8 or 26 plus 3.8. So there's a lot of taxes involved. Whereas if you had invested this money in your home, your primary residence, all that $500,000 tax-free. Zero.
Very important detail about owning real estate and being able to take advantage of that. So one more aspect of this that I think is so important for people as well, like in the DC area, again, not realistic that you would buy something for $100,000. But if you did buy something for $100,000, and say for instance you bought it and you lived in it as your primary residence and you got married and you guys were in there for 2 years and a day, and then you went ahead and decided to rent it out for 2 years.
And 11 months.
And 11 months.
Because you have to be under 3 years.
Right. And then you went to sell it. Because now by holding on to it, now hopefully it's appreciated even more. So now again, you're a married couple, you've bought it, you lived in it for 2 years, then you've rented it out for almost 3, and then you're going to sell it. Now, say for instance, again, you're very lucky and you're making $500,000 on this. Would you pay capital gains tax?
You would have a little bit of tax to pay, but only because you did rent it out for a little bit of time after January 1st of 2009. Now, before 2009, this law didn't exist and you could have evaded a lot of the tax. Any depreciation that you've claimed during those 2 years and up to 11 months, you will have to recapture. But again, the maximum tax rate on recaptured depreciation is only 25%. So again, this is something wonderful that Congress has done, because Congress wants you to own real estate, whether it's your home or whether it's a rental property.
Oh, I love it. It's so important that people know that there are wonderful ways to actually utilize the tax codes when you know it and when you have an expert who can help you. Like Linda, you want to make sure that you're really looking at that and looking at the big picture of how to really take advantage of that. Again, if you have a property and you wanted to rent it out, it might be good to rent that one out while you move into something else so that you can actually take advantage of those wonderful tax benefits of owning it. More than 2 out of the last 5 years, right?
Correct, that's right. And also, there's a special rule for widows or widowers, because sometimes what happens is you have a married couple, they own a property, and then one of the spouses passes away. And under the old law, it used to be that the surviving spouse would have to sell the house within the same year that they've lost their spouse. So if the spouse died in November, then if the wife wanted to claim the exclusion, she had to sell the house before December 31st. That law is gone. They've given an extension of 24 months. So if we have the surviving spouse, they have 24 months from the date their spouse has passed away in order to sell the property, and they can still claim the $500,000 exclusion. That was something very, very nice that they did, and I was so happy when that law went through.
And that's really important, because again, that's a question that we get a lot of times is what does happen when spouse passes away, and again, a lot of times the property value has really gone up, so that tax aspect of it can really change how much money you will actually be able to take away.
Yes, and I always tell the surviving spouse, and it's usually the widow, unfortunately the men sometimes die first, but what I tell the spouse is, don't let the tax tail wag the investment dog. I don't want you to sell the house just because you want to get the tax deduction, because many times they want to stay in their home. There's also a special rule. We have a lot of times where people are getting remarried or remarried and remarried and remarried, and what happens is you have a new spouse living in your house, but you might not want to add their name to the title. So you still can take the exclusion without adding your new spouse's name to the title, provided that this new spouse has lived in the house with you for the prior 2 years, and that you're filing a joint tax return in the year of sale. So let's say that Susie gets married and she has a new spouse, but maybe Susie's 50 or 60 years old and she would like her children to inherit her house when she passes away.
Right.
And she doesn't want to add the new spouse. So that's fine. As long as they file joint tax return in the year of sale, they can exclude the whole $500, even though his name is not on the title.
Wow. See, that's something that most people don't know, especially when you're going to, when we all go through these transitions, and unfortunately, a lot of married, divorce, this happens. And so how do you make sure that you're really thinking about your tax code and your tax, the way your tax strategy is? Again, so much of life is about putting together that A-team of people who can really help you and advise you, because we can't be experts at everything. I'm the expert in real estate, Linda's the expert in taxes. It's very important that you actually put those pieces together and you plan your strategy so that, again, you're making the most of the dollars that you have, kind of stretching each dollar out a little bit more.
And protecting yourself too.
And
This is
protecting
important.
yourself.
I like to protect my clients.
Very important. Well, Linda, again, thank you. So today we were just talking about that, what do we call it, the free lunch in the tax code. It's so important that you really have a chance to look at that strategy, whether you're single or married, and the time frames of 2 years, and if you rent it out, you need to make sure you look at all that stuff. So again, thank you so much, and thank you for being here, Linda.
Thank you for listening to Jennifer Hammond's podcasts. If you liked what you heard, leave a comment or like on iTunes. For more information, visit her website at jenniferhrealty.com.